Hi, so we're starting with the third unit, and we begin by a mention of Netflix. So, in the summer of 2018, Netflix, the online video streaming service, announced that it had added 670,000 new domestic subscribers to its service and 4.5 million international subscribers. And so the stock fell by 14% in after hours trading. Why? How could a large increase in the subscriber number translate to 14% stock price drop? In 2014, activist investor Nelson Peltz took a large stake in PepsiCo and began demanding that it split its snack foods division from its soft drink division. PepsiCo responded by saying, "We trust that you appreciate the seriousness with which we've examined your observations and proposals and firmness with which we reject the proposal to separate the businesses." Peltz then took his complaint to other shareholders, leading to a lengthy shareholder revolt that ended 2 years later when Peltz sold his stake in the company. Why would an activist shareholder fight with the company's upper management? In our retirement accounts, we face choices between different kinds of funds, including active and passive mutual funds. What does that mean? What are mutual funds and how are we different from these evil hedge funds? In this chapter, we will come to understand the who, why, and how of capital markets. Extremely important, right? We want to study capital markets over and above everything else that we want to study in finance, right? These markets are critical for the growth of the economy and increasingly guide policymakers and managers. But these markets have also uh, engendered great skepticism about their values and wisdoms. Regardless of your views in these markets, you will interact with them more and more as a rising manager, a saver, and a citizen. Here we'll explore and demystify capital markets. Most broadly, we're going to ask what roles finance plays in society and how do we structure the role. In the process, we'll confront the prevailing skepticism on the value of financial markets and discover that finance is about much more than money. Okay, why can't finance be simple? Okay, let's talk about that. Why can't the world of finance be simpler? Let's think about a simple version of capital markets. On one side, there would be individuals and households that have savings that they want to invest. These are people like you and me who want to save for college or retirement and want to use that money to generate a return. On the other hand, are companies that need capital to build a new project and grow. So, simpler financial world, we just have the savers and firms, and we would need the mess of finance that exists in the middle, right? So we just give our savings to them, and they can just use that up and give us a little bit of interest on that. So why doesn't the world work this simply? Why can't individuals just give that money directly to the companies and be done with it? In fact, the world of finance looks considerably more complex. Okay, this is that complexity. This is a simple financial world that we are with companies, with projects in the household and savers, and they give their capital and then they give their capital back along with the returns. Why are capital markets so complex? Why do we have so many intermediaries such as investment banks, funds, analysts who stand between the savers and firms? When most people look at the mess of capital markets, they conclude that it's a rigged system filled with leeches that extract value from all the real people in the economy. Indeed, in the wake of financial crisis, this view prevails more and more. As we explore this terrain, we'll try to figure out why the financial world is so complex as it is and whether it really needs to be. This is the actual finance world that we have. We have the companies and we have the households and savers like before, but this this huge sort of mess that we have is comparable to this mess, which is actually not a mess at all. Okay, so these are the other two comparisons that we're making here actually. Okay, so there's returns and capitals and the sort of what not, what even is this? I don't even want to sort of get into this, but that's what we're going to do in this chapter or unit. Who is who in capital markets? To examine all this complexity, let's use the person at the center of it all, the equity research analyst, as a guide. Okay, the analyst's job is to value companies by creating forecasts and then make recommendations to investors. Alberto Moel The equity analyst who examined Corning Glass in chapter 2 did exactly this. Analysts spend most of their day and sometimes nights talking to people. Mapping world's conversations can help us begin to understand this world. Okay, so the first kind of people that we have here are equity research analysts. All right. First and foremost, Mull wants to talk to the companies he's evaluating. Okay, so he's valuation he's doing the valuation. So like Corning, and within these companies he'll talk to anyone he's allowed to. At the minimum, he'll have conversations with CEOs and CFOs, whom he'll ask about new product launches, strategy, forecast. Basically, Mull looks for information beyond the raw numbers that will tell him how a company is performing. So the raw numbers is what he already sort of has. Okay, he wants information beyond that, um, for formulating forecasts that will guide his recommendations, if you should or should not buy. Okay, a recommendation to him, because he needs to recommend to the investors if they should or should not buy this company. And so we'll tell him about a company's, yeah. Since finance is always a two-way street, CFOs such as Dubrow and Clanky, these are the people that CEOs and CFOs, will have their own questions and want to pick Mull's brains, which can be valuable source of industry knowledge and provide a better understanding of the competitive landscape. So it's a two-way street. So not only do they allow him to have a conversation with him about the company and its future and its endeavors and all of that, but they will also have a conversation with him, because he, remember, wants to talk to companies. All right, he's going to talk to companies with an S, so they know that he's talking to other people in the industry. So he has industry knowledge. Okay, and thus he help them understand the competitive landscape better. This exchange of information is one of the key insights into capital markets. Often the interactions take the form of trades, and these trades may not only be in capital. Often these trades are for information or knowledge. Okay, so these equity analysts, okay, industry. So this is basically what we're done with right now. So companies and CEOs are going to give this guy, equity analyst Moel, the company's specific information, and he's going to give them the industry and competitive information. Okay, this is what we sort of done with for now. Institutional investors of the buy side. Moel shares his analysis of the companies he covers with a broad arrow of investors. Right, he's not going to just be talking to one company, and so he is not just going to be interacting with only one set of CEOs and CFOs or CXOs, basically, who will need to know more about the company and other companies with the competitive landscape per se. So these are not just any investors, but rather they are institutional investors. Now whatever chat he's had with different companies, he's going to share it with his investors. That's what he's bound to do. Recommendation to investors, that's what is the main sort of aim of his. So these are not just any investors, not you and me who's sitting at home and want to invest in the stock market. These are institutional investors, so like Goldman Sachs, big companies, investment banks, etc. Big institutional investors, right? Including people like Jeremy Mindick of Scopia Capital, huge Warren Buffett kind of people. People in finance use a lot of different labels for institutional investors, money managers, or asset managers, or more generally, they might refer to them as a buy side. Okay, so buy side, because these are the people who are going to buy, right? So people in finance use a lot of labels for them. Typically, that's what they mean by when they say buy side. But despite the different nomenclature, institutional investors are simply entities that invest large amounts of capital on behalf of others and allocate it in ways that they feel will best support their clients. Okay, so these institutional investors are just the entities that invest large amounts of capital on behalf of some other people. Please remember. So there's a small chunk of, there's a chunk of different people here and there, and these people give these institutional investors some money, and then these institutional investors sort of invest in these companies. Okay, these are the institutional investors that we're sort of talking about. Okay, are simply entities that invest large amounts of capital on behalf of others and allocate it to the ways that they feel will best support their clients, and they basically trade or buy for their clients. Okay, uh, yeah. There are several kinds of funds, including mutual funds, pension funds, foundations, endowment funds, sovereign wealth funds, and hedge funds. There's a huge amount of funds, different kinds of funds that sort of invest on your behalf. The rise of institutional investors has been one of the most important development in modern capitalism. That's what makes it complex, basically. So let's take a closer look at the specific type of institutional investors, so they won't seem so foreign when we encounter them. We'll discuss some of the biggest ideas in finance as we trace through Moel's interactions with these investors. So mutual funds. Mutual fund manage money on behalf of individuals, please remember, and invest those funds in diversified portfolios of stocks and bonds. So important word here is individuals. Okay, to give you a sense of their enormity, Fidelity and BlackRock collectively manage nearly $10 trillion through various mutual funds. There's a good chance you invest in mutual funds through your retirement accounts, because mutual funds invest on behalf of individuals with varying amounts of wealth and sophistication. They are tightly regulated. Okay, and given their exposure to risky assets like stock, they need to manage those risks. Their method for managing risks is an example of fundamental lessons of finance. They hold a wide selection of stocks rather than a few, so that the funds are not overly exposed to any one stock. So they don't invest just in one stock, but they make small allocations of the money or the saving that they have into various kinds of stocks. So even if one does go bad, the others are not entirely correlated. You have money coming in. That process of diversification limits its exposure. Right? That's what we mean by exposure. So that one fails, so you're not. If one fails, all your money does not go down altogether. More important, since the stocks don't all move together, the movements can offset each other and reduce overall riskiness of the portfolio without sacrificing return. So diversification has the virtue of insulating against risk without giving up that much return. This is why diversification is so strongly recommended. In chapter 4, we return to the idea of diversification to talk about how risk is priced. Mutual funds are often diversified as active, meaning a manager personally decides which stock to hold in the portfolio, or passive. Okay, so they can be active, so that the manager is going to decide what to hold or not to hold, or it can be passive. The growth of passive mutual funds, index funds, and exchange traded funds um, has been on has been one of the most important developments in capital markets. Okay, we must have heard about ETFs and index funds, so Nifty 50 is an index fund, like that. So here there you are a passive mutual fund investor. That is, you're not sure which one are you picking, which stocks are you picking. Between 2011 and 18, passive mutual funds grew from one fifth to one third of the money market managed by the professional investors. In 2017 alone, 692 billion flowed into passive mutual funds. Passive funds aren't entirely managed by someone who tries to um, time the market or select underperforming stocks that will eventually rise. Okay. Instead, passive funds simply invest in all the stocks in the broad market, such as S&P 500, which tracks 500 of the most valuable companies. Given their mechanical nature, passive funds are relatively cheap to invest in, but it's not just that they're cheap. Passive funds are a manifestation of the Nobel Prize winning idea of the efficient market theory. This theory suggests that if the information is widely available to investors, then it's impossible to outperform the market because prices already reflect the available information. Right, just talking about the efficient market theory. Okay, so this theory basically says that if information is widely available to investors, if you give them all the information, then it's impossible to outperform market because prices already reflect that available information. Right, the price are already giving you that information, so you can't outperform. So trying to beat or time the market over the long term is useless. It's just basically useless. From this perspective, why pay active managers a lot of money to do something that is impossible? There is considerable debate over the efficient market theory. However, the underlying logic that it's difficult to beat the market on a sustainable basis, combined with the promise of increased gains from the diversification, has proven true and has driven the rise of low cost passive investing at the expense of actively managed funds. So, should you or should you not give your money to a mutual fund who is going to actively invest, uh, or you should just invest in ETFs and index funds? Pension funds. These funds are large pools of money that represent the retirement assets of workers from a particular company, union, or government entity. As one example, the uh, CPERS, CalPERS, manages over 320 billion dollar of pension assets on behalf of public employees in California. Generally, pensions can take one or two forms. So it's basically just the funds that are going to pool a lot of your money from your retirement assets. They basically your retirement assets of the workers from a particular company, union, or government entity. Okay. In contrast, companies with defined contribution plans simply contribute to individual pension accounts that the employee manages. While many public companies have DB plans, uh, pensions have shifted dramatically away from DB plans down to DC plans during the last 50 years. This shift in turn has fueled massive growth in mutual funds. So DB plans is employees receive payment after retirement from their employers, which is funded by pension plans run by those companies or organizations. In contrast, companies with DC plans simply contribute to individual pension accounts that the employee manages. Okay, so employee is managing and they just give that amount to them, and the shift from DB plans to DC plans has is what has fueled uh, mutual funds, because they have the money with themselves and then they're going to contribute. The company is contributing and then they have the money with themselves, so they are going to invest themselves. Foundations and endowment funds. Not for profit foundations and organizations sometimes retain and invest funds over long periods to create more stability for their operations, right? So, uh, non not for profit foundations and organizations have some funds, and so that it becomes more stable, they will invest. These foundations and endowments have grown over the last several decades and now large innovative players in capital markets. For example, Howard University controls a $37.1 billion endowment as of 2017. Sovereign wealth funds. Countries with excess saving, typically stemming from natural resources, often invest those savings through a sovereign wealth fund. These funds have grown dramatically over the last several decades and have become more experimental in their investment strategies. Okay, so countries that have excess savings because they have natural resources, etc., often invest in those savings through sovereign wealth funds. Okay, like the Norwegian sovereign wealth fund, for example, manages a sovereign wealth fund of $1 trillion. It has to be substantially greater now that we're in 2024. 7 years is required. The final institutional investors, the most controversial hedge funds have grown from $260 billion in assets in 2000 to $3 trillion in 2017. Although they have similar to mutual funds, they are differentiated by the lower level of regulation and use of leverage and their different approach to managing risk. Hedge funds, which includes many pension, endowment, and several wealth funds as customers, have lower levels of regulation because only so called sophisticated investors, which just translates to rich, can buy them. Okay. Accordingly, their managers are less constrained in their attitude towards risk. The risk takers, for example, hedge fund may amplify its buying power by buying shares using borrowed funds. So instead of investing $10,000 of a client's money, it will borrow additional amounts from a broker and then invest, for example, $20,000. Leverage will amplify the returns, right? Leverage is just borrowing. Unlike mutual funds, hedge funds can also take more concentrated positions in companies, which allows them to become activist shareholders that promote the policies and strategies most beneficial to their investors. Although hedge funds are willing to assume risk by taking significant stakes in individual companies with leverage, they attempt to manage the risk by, unsurprisingly, hedging. While hedge funds are demonized as being risky, they argue that they are less risky because of the risk management. Mutual funds manage risk by diversifying across stocks, but that still leaves them vulnerable to overall stock market movement. Hedge funds attempt to manage risk better. How can a hedge fund that invests in Merck, a global pharmaceutical company, manage the risk of an investment? A mutual fund would limit its investment in Merck by buying other stocks, but a hedge fund would rather focus its efforts on a company it really likes. A hedge, as in real life, when you want to hedge your bets, is another investment that moves the opposite way that Merck does, so that it provides a return when Merck falls. Okay, for these purposes, consider another pharmaceutical company, Pfizer. Uh, Hedge fund will go short Pfizer to manage its exposure because it went long Merck. What does it mean? Going long is relatively simple, it just means you buy the stock. Going short is more complicated. To short a company's stock, you borrow shares from another investor, such as a mutual fund, while charging a fee for lending the shares to you. So you just ask a mutual fund to lend you um, some shares of that company, and while it charges a fee, I'd say I think $40, at some point in the future you will buy back the shares. Sorry, so once you've borrowed the shares, you sell them, and now that you've borrowed them for a fee, you actually own those shares, and now you're just going to sell them. That's called short selling, such that you don't even own the shares but you sell them. That's how you sell them, because you borrow them at a cost. At some point in the future, you buy back the shares, hopefully at a lower price, okay, and return them to the institutional investors you borrowed the shares from. And now at some point in the future, you're just going to buy them back. That's what Bloomberg etc. did with the Adani shares, right? They shorted them. So shorting basically means they borrowed these shares from somebody for a time and then just sold them for whatever that price was going, and then they bought it back, but now at a lower price, and then just sold just gave them back, not sold, gave them back to that institutional investor, mutual fund in this case, whom you borrowed it from, right? So imagine you go short Pfizer at 40. Actually, this is the price, right? So Pfizer then drops to 20. How have you done? You borrowed shares of Pfizer, sold them, and you received your 40, right? Later, that's what we're talking about. The What's about, you sell them, so you sell them at 40 because you bought them, because that's what we're assuming is a going price. You bought shares at 20, and then when you bought them 20 and then returned the shares, leaving you with a gain of 20. So when you sold them for 40, and then when you actually bought them back, you got that for 20. This means that you'll make money when Pfizer declines, okay, when it falls. If Pfizer went up to 80 or 120, you would actually end up losing a fair amount. In fact, if you could lose far more than you had initially committed. How does this relate to hedging? Let's imagine that both Merck and Pfizer are selling for 100. You decide to go long Merck, right? You buy it, but how can you manage that risk? You don't want to buy another pharmaceutical company or other type of companies in mutual funds too. Instead, you go short Pfizer for the same total dollar amount as your long position in Merck. How does your investment strategy perform? Let's look at real data from 2012 to 2014 in figure 3-4. Okay, yes. During 2012, both Merck and Pfizer stocks were moving together quite tightly, right? They're almost together till 2000, till 12. By December, they'd both gone up by 20%, and by December, they're going up 20%. Okay. If you sold your Merck shares and repurchased Pfizer shares at the end, thereby closing out your position, you would end up in the same place where you started, right? Because they've both gone up 20. The gains on your long position plus 20% because Merck went up, and offset by your losses on your short position minus 20% because Pfizer went up too. Now let's look up 2013. Okay. By the end of 2013, Pfizer had outperformed Merck. It's going well above Merck. By December, Pfizer was up 50%. December 2013. Pfizer is up 50%, right? And Merck only 40%. Because your Pfizer stock went up more than your Merck stock went up, your short outperformed your long. You lost money because you've shorted Pfizer and you've longed Merck. So because Merck did not go up more than Pfizer, rather less, you lost money. Okay. Finally, let's look at 2014. During that year, Merck outperformed. Merck is now going up. It's outperforming Pfizer. By December, Pfizer has risen a total of 60%, and Merck had risen a total of 70%. Because your long outperformed your short, you made money. So hedging can help insulate an investor from sector-wide or market-wide movements and isolate the relative performance of a given company. In that sense, you have managed risk because you are now exposed to only the relative outperformance of a company's stock. Hedge fund managers also receive carried interest in the compensation model that allows them to participate in the economic returns of the fund. The combination of leverage and carried interest rate means that fund managers are particularly attracted to outsized returns and will go to great length to find investment opportunities, right? So, as one example, consider a fund manager looking to save JC Penney will have a good holiday season. Rather than talking to analysts such as Moel or building the models we saw in chapter 2, they may go to greater lengths such as taking satellite images of JCPenney parking lots on Black Friday to get an early sense of stores' quarterly results, or hiring former counterintelligence officers to verify the validity of the executive statement. Or if the hedge fund is shorting a stock, it may be willing to publicly attack a company, right? These aggressive maneuvers attract supporters who appreciate the work hedge funds are doing and produce detractors who consider them vaguely evil for attacking companies. Equity research analysts like Moel pitch ideas to these varied institutional investors, but what do they do in return? Institutional investors don't actually pay analysts directly for their ideas. Instead, investors rank analysts based on the quality of their recommendations. These ratings are critically critical component of the analyst compensation. Indeed, being the number one ranked equity research analyst can lead to compensation that's several times out of a number 10 ranked analyst. Taken together, these institutional investors make up the buy side, a collection of organizations that accumulate funds, often from individuals, and use them to buy assets in the financial markets. That's how we are sort of calling them. Who is the buy side buying from? Mutual fund managers don't typically knock on the doors of companies and offer to buy their stock directly. For that, they reach out to the sell side. Okay, let's just give this a read. Jeremy Mindick, founder of Scopia Capital, a hedge fund in New York City, commented on the hedge fund business model. Scopia's basic investment philosophy is that we should be able to find great longs and great shorts at any moment in time, so that the disparity of returns between these long positions and those short positions should be the source of our stream. We're not looking for short-term trades. We're looking for to invest in companies because of their quarterly earnings. Okay, so we always had the idea that you can find in any market environment companies that are grossly mispriced, both undervalued and overvalued. To construct a long or short value portfolio, we call ourselves a market neutral fund, which means that we have little or no net exposure to the stock market. Generally, market neutral funds are quantitatively driven, so they tend to be collections of stocks driven by a quantitative algorithm that creates a basket of 200 to 300 undervalued long ideas by whatever favor criteria, and another couple of hundred short ideas that are, for whatever reason, considered overvalued. The hope is that by leveraging the portfolio and squeezing out some small differences in returns, you can create an interesting return scheme, because even if these differences are small, the amounts invested actually make them really big. At Scopia, we're trying to have a concentrated portfolio of roughly 20 to 25 long ideas and roughly 30 to 40 short ideas. The long ideas are deeply researched, significantly mispriced, overvalued, undervalued companies, and the short ideas are also deeply researched, significantly mispriced companies. The vision we have for the future of those businesses creates the investment opportunity. Whatever these people think and research about the vision of these two companies, types of companies, is what makes these profitable.